Welcome to the deep dive. Today, we're really diving into the heart of real estate investment strategy. We're tackling that, fundamental question every successful investor has to answer: what kind of property actually fits my goals?
Right, because real estate is definitely not a monolith. When you start investing, you're essentially balancing, let's say, three key things.
Hmm.
Appreciation, potential, immediate cash flow, and, well, the management load.
Management, yeah.
And the property structure you pick, single family, condo, multifamily, that choice fundamentally sets where you land between those three.
It really is the blueprint for your whole investment, isn't it? That decision impacts financing, how much, hands-on maintenance you're doing.
And how fast your portfolio can grow.
Exactly. So our mission today is to cut through some of that noise.
Mhm.
We want to give you the specific pros and cons of single-family homes, condos and townhouses, and multifamily properties. The goal is so you can figure out which option really lines up with your budget right now, the income you want, and, frankly, the time you're willing to spend dealing with tenants.
Let's do it.
Okay, let's start where, well, most people seem to start. The single-family home, the SFH. It often feels like the default choice, maybe for first-time investors, just because it's so familiar.
It is familiar, and it's often the easiest one to get financing for.
Mm-hmm.
Compared to complex multi-unit deals, banks kind of prefer the, let's say, stability and clear valuation of just one house.
Simpler.
Yeah, much simpler. It makes the banking process smoother, and the exit strategy is usually clearer, too. SFHs tend to be pretty liquid when it's time to sell.
And they often attract those, desirable long-term tenants, families maybe, which can mean simpler property management day to day.
Yeah.
But the biggest advantage, historically anyway, seems to be that appreciation potential.
Absolutely. You're buying the land underneath the house, and in good neighborhoods, that land value is often what drives really rapid appreciation. It's a strong vehicle if your main goal is building equity, over the long haul.
Okay, but then there's the drawback. And it's kind of brutal in its simplicity. It's the thing that I think stops a lot of new investors cold: vacancy risk.
That's the critical downside, yeah.
Right.
With just one unit, you have zero income diversification.
Yeah.
None. If that house sits empty for a couple of months,
Poof.
your rental income goes from 100% to 0%, like instantly.
Right.
But the mortgage, the insurance, property taxes,
Yeah.
those bills don't stop coming.
Right. So if your number one goal is immediate monthly income, that cash flow, the single-family home, might actually be a bit disappointing, even if the long-term appreciation looks great on paper.
Precisely. Take that example. We looked at a single-family home in a fast-growing Utah neighborhood. That house might just skyrocket in value because demand is high and there's not much for sale.
Okay.
But the monthly rent you can charge, it might only just cover the mortgage and expenses. Maybe you break even. Maybe you pocket $50 a month. You're basically making a bet on the long-term gross, often sacrificing that immediate cash flow to do it.
That appreciation versus cash flow trade-off seems really central here. Okay, let's move on then. What about the property type that often has the lowest barrier to entry, condos and townhomes?
Yeah, the upfront cost, the initial capital needed, is typically lower than a detached single-family home. But the real defining feature here is maintenance, or rather, the lack of it. This is really the choice for investors who crave, time freedom.
Because you basically get to outsource all the sweaty labor, fixing gutters and mowing lawns.
That's exactly right.
Yeah.
The Homeowners Association, the HOA, they generally handle the big stuff: the roof, the exterior walls, painting, common areas, the landscaping. So if you're an investor with a really demanding job, or maybe you live far away from your investment property,
That makes sense.
that ability to just hand off the maintenance burden is, well, invaluable to some people.
But the HOA isn't doing it for free, right? They charge fees, and sometimes those fees can seem, well, pretty punishing. Does that financial hit from the HOA ever actually cancel out the low maintenance benefit? And what's maybe the biggest surprise investors run into with HOA rules?
Oh, it absolutely can outweigh the benefits sometimes. I've definitely seen deals that looked great on paper for cash flow, but then you factor in these really steep HOA fees, and suddenly that profit just evaporates. It turns into a break-even thing, or worse. Beyond the fees, the real surprise for many is the lack of control. You might decide, okay, I want to replace the carpets in my unit. Makes sense. But then you find out the HOA dictates the exact color and grade of carpet you're allowed to use.
Wow. So you can't just repaint your front door whatever color you want. Maybe you can't make significant changes inside.
Sometimes those rules even limit your ability to rent the unit out, like maybe no short-term rentals allowed, or they might even have rules about your tenant screening process.
Okay, so less control.
Right. And for you, the owner, Those restrictions can sometimes translate into slower appreciation compared to a detached home where you have total freedom to make upgrades and boost that curb appeal.
Got it.
So the ideal investor here is probably someone who's, budget conscious, wants to start small, maybe test the waters, and crucially, someone who sees that low maintenance aspect as their most valuable asset. If the mere thought of spending a Saturday fixing a leaky gutter gives you instant heartburn,
Uh-huh.
this is probably your lane.
That makes perfect sense. Okay, now let's talk scale. Let's talk cash flow focus. Multifamily properties. So we're talking duplexes, triplexes, fourplexes, maybe even bigger, though we'll get to that. This feels like the structure built for maximizing that monthly income.
Yeah, and what's really interesting here is how the whole risk calculation kind of flips completely from the single-family home model.
How so?
Well, the powerful advantage is that built-in protection from multiple income streams. Think about it. If you have a fourplex, 4 units, and 1 unit is vacant for a month.
You're still getting rent from the other 3.
Exactly. You're still collecting 75% of your total potential rent. That dramatically lowers the risk of zero income, which leads to much more reliable, predictable cash flow month after month.
And I guess that income diversity allows for much faster scaling, too. Once you've figured out how to manage 4 units under one roof, moving to 8 or 12 units seems like a smaller jump than going from one single-family home to, say, 8 separate houses scattered across town.
Absolutely. It's really the path towards building a genuine rental business rather than just sort of collecting rents here and there.
Right.
But you definitely need to be prepared for the trade-offs.
Okay, like what?
Well, first, you're usually dealing with a much higher purchase price up front. And while the potential income is higher, you almost certainly have to be more active in management. More tenants just means more communication, potentially more maintenance calls, more turnover between tenants, and generally just more wear and tear on the property overall.
Right, more moving parts. Okay, let's talk about financing for a sec. Because there's a really critical hurdle investors hit when they try to go beyond 4 units, right? Like
Right.
moving from a fourplex to a 5-unit building.
Yes. This is where the game really changes fundamentally. For properties with up to 4 units, so a single family, a duplex, triplex, or a fourplex, you can typically use standard residential mortgages.
Okay, the kind most people get for their own home.
Exactly. And those usually offer better interest rates, maybe more favorable down payment options, things like that. But the moment you hit 5 units or more, now you're stepping into commercial lending territory.
Which means, what exactly? More paperwork, higher rates?
It generally means stricter financing requirements all around. The bank's valuation criteria shifts. It's less about just comparing sales of similar buildings and much more focused on the property's income statement. Is it generating enough income?
So they're underwriting the business, not just the building.
Precisely. The bank is primarily evaluating the business performance of that property, and that usually demands a higher level of professionalism from you. The borrower detailed records, projections, and often a significantly larger down payment, sometimes 25% to 30% or even more.
Okay, that's a big jump. So for the investor who's really laser focused on maximizing monthly cash flow, who can handle that increased management complexity, and maybe even wants to use strategies like house hacking,
Right, living in one unit yourself.
while the rent from the other units pays the mortgage for that person, the multifamily property, specifically up to that fourplex size, seems like the clear strategic winner for income.
Yeah, I think so. If you look back at that Utah example, a fourplex in a solid rental neighborhood, it produces steady, reliable monthly income. It gives the investor immediate cash. And because the demand for rental units stays high, especially if buying is expensive, the property itself also tends to grow in value over time. It gives you the best defense against that vacancy risk while really maximizing the income potential, especially in that 1 to 4 unit space.
Okay, so we've covered the 3 main types. We've really hammered on that central conflict, appreciation versus cash flow versus maintenance load. How does someone listening translate all these pros and cons into like an immediate actionable strategy for themselves?
Right, we need to connect the property type directly back to your primary financial goal. Let's try to make it really clean and simple.
Okay, give us the framework. How do we decide?
All right. If your number one goal is long-term portfolio stability and you want the absolute highest potential for market appreciation, maybe you don't need the cash flow right now, then you should probably focus on the single-family home. You're essentially buying location and land value potential.
Okay, goal is appreciation, SFH. What if the goal is minimizing hands-on hassle, like the lowest effort possible and an easy, maybe lower cost way to just get into the market?
Then you'd prioritize the condo or the townhouse. You're
Mhm.
making a strategic trade-off there. You're giving up some control, maybe accepting a potential ceiling on appreciation in exchange for significantly less management effort. You're optimizing for your time.
Makes sense. Time is money too. Okay, but what if the goal is immediate, robust income and maybe scaling up the portfolio relatively quickly? Go
Yeah.
for leverage, right?
Then multifamily, specifically up to 4 units, is likely the ideal path for that cash flow and scale. And, it's really crucial to realize that each of these property types can serve a distinct purpose at different stages of your investing journey.
Ah, that's a great point. It's not necessarily just one choice forever.
Exactly. You might start out with a low-cost condo just to get your feet wet, then maybe transition to a single-family home for a period to capture a big chunk of appreciation wealth. And then later on, maybe you consolidate that equity into multifamily units specifically for generating guaranteed retirement cash flow. Your strategy can, and probably should, evolve.
That perspective that your strategy changes over time, that's incredibly helpful, I think.
Okay, to ground this theory a bit more, let's loop back to the specific market context we looked at earlier, using Utah as our example. Why does a market like that seem to support all three strategies at the same time? Well, the Utah market is actually a perfect illustration of how these three types can kind of feed off each other. Because single-family home prices there escalated so quickly, driven by really high demand and low inventory.
Right, we hear about that a lot.
Affordability for the average buyer just got severely strained. It became really tough for people to buy a house.
Okay, so those super high single family prices actually end up driving up the value of the other property types? Is that how it works?
That's nicely. That escalating single-family pricing, say in the Salt Lake City suburbs, it actually inflated condo appreciation significantly. We saw numbers like 8% year-over-year increases. Effectively, that affordability pressure on houses turned into an appreciation driver for people investing in condos.
Huh. So condos and townhomes get popular because they're cheaper to buy, but then they also start appreciating faster because the single family market is just too hot for many people.
Exactly. It creates this knock-on effect. And then, for the multifamily properties, the duplexes, the fourplexes, the demand for rentals stays incredibly strong, not just from investors looking to buy them, but from renters who simply can't afford to buy a house anymore.
Right.
And because there's often a limited supply of these smaller multi-unit buildings compared to single-family homes, the competition to buy them stays high among investors. That supports both strong rents and increasing property values. So you end up with a market that's actually supporting appreciation, affordability-driven demand, and cash flow, all at the same time across different types.
That really paints a clear picture of how those market forces connect these different investment types. It's not just choosing in a vacuum. Okay, so this deep dive should hopefully show you, the listener, that the best investment property. Well, there's no single answer, is there?
No universal winner.
It really is entirely dependent on your personal goals, your financial comfort level, how much risk you can stomach, and critically, the amount of time you are actually willing and able to commit to managing the thing.
Yeah, you need to be pretty ruthless in your self-assessment. Really analyze each option through the lens of your own long-term financial plan. Don't just chase whatever seems hot in the headlines. Chase the strategy that actually solves your specific financial needs and fits your life.
So, our invitation to you is this. Don't just read about market growth. Try using some online analysis tools, or maybe find local investment club meetings or events. Look at the actual spreadsheets for real deals. See examples of single family, condos, multifamily in your area.
Dig into the numbers.
Yeah, dig into the numbers yourself. See how the cash flow projections, the appreciation assumptions, and those maintenance costs really differ in practice.
And that really raises an important question for you to maybe think about this week. When you're forced to decide between maximizing appreciation potential versus having immediate, stable cash flow, which one of those metrics is most likely to accelerate your personal freedom? And how should that answer guide your choice of a 1 to 4 unit property right now?